Hello, everybody. Welcome to the Daniel Wynn podcast, where we talk about private lending, real estate loans, how to get real estate loans, how to do private lending, and how to live a happier life in between all of this and balancing all that out. Today, I want to talk about fix and flip real estate loans and the fastest way to get them funded if you're the lender or you're the borrower. I want to share with you what we look for as a private money lender and how that could benefit you in the future. So why do investors come to private money lenders for fix and flip loans? Simple. We get a lot of loans that the banks won't touch. The main reason why people come to fix and flip lenders is because we are fast. We're able to do these loans in a matter of days or weeks. We've often closed loans in our office in under 7 days. So that's one of the main reasons. Fix and flip loans are typically 6 or 12-month loans, so they're interest-only loans, and they're simple to put together with a lender that has experience putting fix and flip loans together. How do fix and flip loans work? Simple. Most fix and flip lenders are concerned with three main things: credit, skin in the game, and the overall strategy for the property. When you submit a loan to us for fix and flip, the first thing I'm going to do is look at the property online. I want to see the neighborhood. Next, I want to look at the budget, what you're buying it for. I want to look at what you're going to estimate the rehab for, time frame, to see if those numbers make sense. And then I'll look at your credit and experience. Now, the cool thing about fix and flip lenders is they don't require credit being the main priority. Well, let me rephrase that. Some lenders are very credit driven in fix and flip, and some are not. Our company will make exceptions for people that don't have perfect credit. We just lower the loan to value, so that helps us lower our risk for these fix and flip loans. Common pitfalls for fix and flip loans that I'm always on looking out for. When we review the numbers, purchase price, rehab, etc., and the overall cost, and we look at the projected after repair value, we want to make sure there's a good spread for that fix and flip lender to succeed. Now, over the last 10 years, I've closed over 600 loans, private money loans, and probably a third of those were fix and flip loans. And what I've learned that is many times rehabbers overestimate the future value or what they're going to sell it for and underestimate the cost to put the property together or rehab it. There often seems to be big surprises or small surprises that add up when you're remodeling a property. So we have to weigh that out when we're making a loan and underwriting a loan. And if a person has the experience, then we may give them a credit for that. If they don't have the experience, then we want to cut back the loan to value in order to make the loan safe for us and better for the borrower, because we will not do loans for borrowers that does not look like they can make a profit from the transaction. Also, when we do rehab loans, we hold as much money as possible in the rehab escrow and pay it out as work is completed. So let me give you an example of how this works. You buy a property for 50, the rehab budget is for 50, and the after repair value is 150 plus. So if we make that loan, that would be a 65% loan to value loan, right? If we did 100% of the purchase price and 100% of the rehab, which we don't do, by the way. We normally want the borrower to have at least 20% of their own funds. But let's say, an example, we did fund $100,000. We would probably only fund 25% of the rehab at the closing when they made the purchase. That means that we would hold the other $35,000 in a construction escrow at the title company. Once the borrower completes the work or the first phase of the rehab budget, they then submit a request for a loan draw, and we send out an inspector. They go take pictures, they make sure that the work was done. We get lien waivers if any contractors were involved. Those are submitted to the title company, and when all that is done, we will disperse the next disbursement on the rehab budget. This is the way we protect ourselves as private money lenders and help the rehabbers to make sure that they aren't getting taken advantage of by contractors, or spending money on the wrong things, getting distracted. Not that they would ever happen, right? You come in with the idea of doing this, and then a month later you want to do that, and that wasn't in your scope of work. So we keep them on track with their scope of work. So how do rehabbers and people get approved with us? Let's go through the process very simply. They send in a loan application. We review the property and all the paperwork, like the scope of work, like I went over. We look at their credit, their experience, and we take that information and we give them either an instant approval, a denial, or a maybe. And a maybe means we need more information. Maybe they have to tweak some of the numbers in the scope of work. Maybe they have to give us some more information to help us make a good decision and change it from a maybe to an approved. So if you're looking for a fix and flip loan or you're looking to fund fix and flip loans, these are the criteria that you should be looking for. We have a guide online that you can download that will share this with you, so you can download it if you like. If you're looking for loans, if you're a mortgage broker or a realtor and you're looking for a good fix and flip lender, give us a call. We'd love to do business with you, and we look forward to doing business with you this year. We wish you a lot of success. See you in the next video.